Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJ Harrison Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I'd like to welcome Joel Clark, CEO of KJ Harrison, here with me today. Joel, as we approach the end of Q2, it's a good time to get an update for you. Thanks for joining me today.
Yeah. Good morning.
Good morning. So, Joel, we had our mid-year client event last night. And as Peter Barlis, our chief investment officer, rightfully pointed out, actually with a great graph of the market, everything has changed since the beginning of the quarter, since April 1st, yet nothing has really changed. So give us a big picture from the perspective of the investment team on what's been driving the market and where you see things heading from here from both a risk and return perspective.
Sure. And I mean, it's an ironic observation because we started the year at S&P, call it 6,000, and that's exactly where we are today. And it seems like nothing's really happened. But of course, during the month of April, we had the third worst drawdown in my career. The S&P was down close to 19%, the NASDAQ close to 25%. So it was quite volatile, but we completely round tripped. And just going back to our last few podcasts, many of our clients and listeners know that this is really self-inflicted as Trump came forth on Liberation Day with a set of draconian tariffs that really spooked the market. And it's not clear whether it was his intention all along, it was a form of negotiation, or in fact, the market put him in a box. And we now know that Trump does really have a breaking point. So, market's down 25%. The bond market did not cooperate. Yields reversed on him. He had the intention of getting yields down to sort of term out $7 or $8 trillion of debt. That did not happen. And probably every CEO and congressman of every state in the U.S. phoned and said, one more month of this, you have just orchestrated a recession. And for the world's largest economy and largest market, and going into midterms now a year and a few months, that is not what Trump wants. And so here we are. He's backtracked. It's not quite clear how much damage he inflicted, but certainly putting on hold the tariffs is a positive. As a CEO of businesses, you can't commit capital, you can't make decisions. Uncertainty is the kiss of death in business. And so the fact that we have a bit more clarity is obviously a good thing. And that leads to my first point, which is I think we've avoided a recession. 2 months ago, wasn't so sure, but for all intents and purposes, I think as we sit here today, recession avoided.
That's great. Thanks, Joel. I think that's a good start. So let's go to the tariffs. So help us understand a little bit about the uncertainty around trade and tariffs, though, going forward. So what does it look like is going to happen from here?
It's not overly clear because, of course, he's just paused them. And so the market is certainly taking a major leap that he will not reintroduce tariffs, certainly not at the level that he originally intended. It's given them time to negotiate with certain countries, although they haven't come forward. So I think the bet is, although it's not clear, that he's just not going to inflict the level of tariff. So again, sort of an odd spot because we actually don't have clarity. We just have a sense that Trump has a breaking point and there's a big risk for him to go back there. So I don't really have a clear-cut answer for you because it's not known. And so markets are betting on the fact that cooler heads will prevail. And certainly within the administration, as Peter pointed out last night, the shift internally from Navarro to Besant is a plus because Besant is more friendly as it relates to repairing trade relationships.
Yeah, that's for sure. That was an interesting shift to watch. And as you said, rightfully kind of points out that Trump does have an eye on the market and how the market is responding. As Powell said the other day, tariffs will have to be paid by someone, whether it's exporters, importers, businesses, or consumers, or a combination of all those four. And that the risk of the tariffs and however they unfold, as you said, it's unknown right now, will lead to inflation and maybe even stagflation. So unpack that for us.
Sure. GDP estimates have come down. So at the moment, we're in a lower growth environment, while at the same time, you've seen the price of oil because of the Middle East go up $10. You've seen commodities reaccelerate. You've seen bond yields reaccelerate. So in the back half of the year, we have inflation potentially reaccelerating, and that's a tough environment. Low growth but high inflation is not really what you want. And so the US knows this, and they're trying to reaccelerate growth. They're doing it by the big beautiful bill, and they're doing it by pressure to lower interest rates on Powell. They're easing lending regulations to get the velocity of money going. So they're well aware that the only way out of this structurally high debt inflationary environment is to grow their way out of it. So it's whether or not they can do that. And the economy is muddling along. Pete and Andrew put up a great chart of a train sort of on its heels, not completely derailed, but just sort of hanging on. And I think that was a really good visual to describe where we're at with the economy. So really comes back to the back half of the year. If cooler heads can prevail on trade, we haven't talked about this, but the geopolitical situation stays fairly contained and regional, and we get confidence with the CEOs, then I think growth reaccelerates, and we might see new highs in the market in the back half of the year.
Yeah, we haven't talked about geopolitical, and I think it's important that we touch on that. There's a lot happening globally, a lot of strife. Can you touch on what that means for the markets?
I think, and it's not for you and I to get into the politics of it. It's all about how it relates to markets and doing our job of either managing risk or producing returns. But this will now be the second theater where the US is potentially drawn into a conflict. They're already in one, Russia, Ukraine. This would be the second one. They have internal strife within the US. They're getting stretched, and that costs a lot of money. And this is a government that's debt levels are already out of control, and they're going to have to print money and spend it on planes and bombs and artillery. And these aren't good things. It takes their eye off the ball. There's always unintended consequences, another set of unknowns, the price of oil up $10. That's not good. That's inflationary. That hits the US consumer. So it's just another thing to worry about. And markets, they put a higher equity risk premium when there's uncertainty. And so, with valuations as stretched as they are, I think there's potentially valuation risk if the positives that I just talked about, lower taxes, growth, stability, don't play out. I think there's a bit of risk to where we are with the market right now.
Yeah, and we're seeing that in the bond market. The bond market is watching these increasing deficits, whether it's from, as you said, the fiscal package or the bill, the reconciliation bill, the big, beautiful bill. The bond market is reacting. What are your thoughts, or what are Peter's and the investment team's thoughts around how the fixed income market is performing in here or reacting to this?
Yeah, that's the number one problem that is not going away. Okay, so you can a regional conflict, you can come to some sort of resolution there. You can lower taxes, you can chip away at deregulation. But the one issue that is front and center that is not going away is the high levels of debt that we have and the cost to carry them. And it's exponential. And so the bond market is for sure that's front and center. You've seen a very significant rise in precious metals, hard assets, because that's hurting traditional fixed safe haven assets like fixed income and government debt, currencies. And so the bond market is really running the show in my mind. It's clearly what forced Trump to change is tacked on tariffs, and it's a problem that's not going away. And unfortunately, the only solution is to inflate your large debts away. And so the implication to your investment strategy is such that you have to bet that we're shifting in the future to more of an inflationary, stagflationary investment strategy focused on hard assets, commodities, more Canada, more global, very different from maybe the past 10 years outside of really one sector, and that's technology, AI, and productivity. That really could be the area that hypercharges the growth cycle.
Yeah, stagflation does seem to be the buzzword going forward, where we have weak growth and rising prices, and seems to be almost the trickiest challenge. But as you said, leads to this growth in hard assets. So let's talk about Canada, because what you've seen with Canada and the growth of these hard assets, gold, as you just talked about, as Canada has performed well in here. How are we thinking about the Canada US split and the opportunities in the Canadian market?
Yeah, Andrew touched on that last night in another staggering chart, just emphasizing what we all know, that the US is the largest economy and market by factors and multiples. I think it was 60 trillion is the market cap of the US, multiples of everywhere else. So, and they truly do have the best companies in the world, diversified economy, a deep economy, liquid, transparent. So obviously highly investable. That's why we spend a lot of time talking about the US. We're at the moment, 60-40 split, probably 60 US, 40 Canada. And the Canadian economy is highly concentrated in materials, energy, and financials. I think it was close to 40 or 50% of the market. But in a inflationary, reflationary economic environment, Canada's really well. We have a lot of resources on the ground, and the world is growing and is in need of all these resources. So there's been a huge underinvestment, and whether it's copper or energy or whatever commodity, many of which are used for the electrification in the world. And so there's a real investment case for Canada right now, and you're seeing it in the results. The TSX is up 8% year to date, and 1 year is up 16 to 18%. So it's on a bit of a tear, and we've talked about this over the last 3 to 6 months on this podcast, that we could be shifting to outperformance for a period of time of Canada, global over the US.
Yeah, we've just talked about how there's so much headline news. Talk about how our process is really about owning the highest quality businesses and best of breed companies, and why we continue to stand by that in this environment of heightened complexity.
We will never lose sight of our investment philosophy and discipline, which, to remind people, are buying the best businesses in the world in industries that are growing, that have strong fundamentals, strong financial metrics, clean balance sheets, well-aligned management teams. And the reason is very simply is good businesses go up over time and they go down less in times of trouble. They take advantage of chaotic economic periods and make important progress vis-a-vis their competitors. So that's our tried and true disciplined. It's always suited us well in times of uncertainty. We know our businesses well. We can reflect on their positioning, their balance sheets, and we don't panic. We don't trade headlines and in and out of securities. We let management teams compound our capital with their businesses. And so that remains our number one focus, whether or not you're in the US or Canada. A common, obvious theme when you look through our portfolios is the fact that the companies we own are number one or two in their respective industries.
Yeah, that's great. So, Joel, it went by very quickly today, our podcast, because there was a lot to talk about. And I think we should probably think about wrapping up here. Any final thoughts you want to leave for our listeners?
Sure. I think two general comments. One, we avoided a recession, and I sort of say for now, and I feel it's a bit binary. There are a lot of things that could fall into place that could make the back half of the year reaccelerate, and off we go. Conversely, a lot of things could fall apart. Trade deals could fall apart. geopolitical could flare up, become more than just regional. The bond market could misbehave, and we could easily retest the April lows. And so it really does come down to a few sort of decisions here by policymakers on how the balance of the year plays out. And that leads to, well, how do you manage that? We still believe diversification, good balance between credit and equities is important. And then number two, maintaining a focus on owning the best businesses that allows them to ride out these turbulent times.
Yeah, I think that's a good place to leave it because a lot of news is priced in. But having said that, I think if this we're still in a period of uncertainty, as we just talked about, and being diversified is really important in here, and really not trading the headlines. Trading the headlines is a sure way to permanently destroy value.
Exactly.
Okay, well, thank you very much, Joel. And thank you to our listeners for joining in today. We'll be back next month, as Joel said, with another issue of our KJH Insights podcast. So, wishing everyone a happy longest day of the year tomorrow. And if you have any questions, please reach out to your portfolio manager or anyone on the investment team. We'll continue to provide you with commentaries and updates as the market narrative unfolds. All of those are available on our website at kjharrison.com. So we look forward to speaking to you again next month. Thanks very much.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.